Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us at the MarketSite studio in Times Square, New York City, we have Greg Friedman, founder and CEO of Peachtree Group. We're going to discuss trends in commercial real estate and why there's opportunities in private credit right now. Greg, it's great to have you with us. Welcome to TradeTalks.
Yeah, thank you, Jill, for having me.
A lot going on in the CRE space. What are some of the trends that you're seeing?
Yeah, definitely. There's no question there's a lot of volatility in the market. The debt markets for commercial real estate have pulled back. 40% of the debt markets are driven by regional banks, community banks, national banks make up 40% of the lending market. Most banks today are trying to shore up their liquidity position. So that's putting a lot of pressure, just the lack of debt liquidity, and you have this huge wall of debt, debt maturities that are taking place across all commercial real estate assets over the next 18 to 24 months. So between now and the end of 2025, you have $1.5 trillion of commercial real estate loans that are maturing, and that's creating a lot of interesting opportunities.
So because there's lack of debt capital supply, that's why you're seeing those opportunities in private credit?
Yeah, exactly. So we're seeing, as a firm, we invest both on the private credit side, so we're a direct lender, as well as we buy a lot of distressed debt from financial institutions, but we also lend to a lot of commercial real estate owners. We also buy real estate assets, buy primarily hotel assets across the U.S., and that wall of debt maturities is the catalyst, in our opinion, that's going to create a lot more opportunities. Those opportunities on the direct lending side has already started. Like being a private lender today, there's incredible opportunities to be able to go lend at lower leverage points today than what we were doing, say, pre-pandemic, just given all the volatility in the credit markets.
So are they structured the same as a traditional bank loan may be?
Yeah, these are structured very similar in the sense that they're typically 3 to 5 year first mortgage loans that we're originating and making and funding through our investment vehicles, but we'll turn around and create a 3 to 5 year term loan that's a first mortgage loan secured by the underlying real estate asset, where we're financing 60 to 70% of the total acquisition costs, development costs, or even the value of the asset if we're recapitalizing an existing asset. And ultimately, just given what's been created by this volatility in the debt markets, we've been able to, now we're getting equity-like returns where our last dollar of exposure is only caught about 60%, 70% of the total acquisition cost.
What's performing best in the commercial real estate space?
Yeah, from a standpoint of just assets, I would argue that hotels are probably performing extremely well and probably performing better in the sense that there's less negative leverage within hotels because they trade at higher cap rates. So hotels traditionally trade in that 7 to 9% cap rate range. You take multifamily, industrial, self-storage, at the asset level, they're performing extremely well, but they had compressed down to such low cap rates in the middle of the pandemic. In a lot of cases, they were trading sub 3% cap rates. Now their cap rates are expanding out because there's no risk premium spread, just given where the 10-year treasury rate is today, because the 10-year T is a little under 4%. And so in a lot of cases, those trades that occurred back in 2020, 2021, and even the first half of 2022 at those low cap rates, they're in a negative, not only in a negative leverage perspective from a debt perspective, but also just their equity is upside down. And so hotels, given that they trade at closer to 8%, you have a good 400 basis points of risk premium spread even in today's market. And to me, also just at the asset level, hotels are performing extremely well, just given there's a lot of secular trends that favor travel on the demand side, and supply is very muted. There's not a lot of new supply getting built given what happened during the pandemic and given the volatility in the debt markets today.
So how should investors be thinking about the real estate space? Because it's a very broad umbrella, and there's some verticals that are working, some that aren't.
Sure. So I personally think, today there's, bifurcation sort of taking place across asset classes. Obviously, there's a lot of secular distress across office, which makes it very tough to invest in that space today. I think at the asset level, there's not really a lot of asset level distress across most of the other assets I mentioned. But I think, I view the market as very investable on the private credit side right now, just given I do believe there's going to be a lot of volatility in valuations until the Fed is done, increasing rates. Obviously, inflation's, starting to moderate, and there was a good, obviously, today with just what was reported, it looks like there's a good chance the Fed is closer to being done on raising rates, but I think there's not going to be any catalyst in the near term for rates to drop. And so ultimately, I think just when you're investing on the equity side of commercial real estate assets, you just got to be very careful, given the fact that I do think cap rates are going to continue to expand out because we're going to be in this higher interest rate market.
Let's say we go back to a normal environment. Let's call it pre-pandemic. Interest rates are lower. Banks are doing more lending. Do you think that real estate is still going to access private credit because perhaps the structure is more favorable, or do you see that shifting at all?
Yeah, I think private credit is here to stay. I think private credit has grown through the, going back to the, GFC. Private credit became a very big vehicle because banks started pulling back on commercial real estate lending. A lot of banks like to partner with us on our private credit lending platform because they can finance us to go finance other groups. And a lot of times they can, classify and account for those loans as a C&I loan versus a commercial real estate loan, which just helps them from an accounting perspective. But more importantly, they know they have another layer of liquidity because like within our platform, we're vertically integrated. So we operate, we develop, we lend. So if something does go wrong, we can step in and fix those issues.
Is it too early for office, or do you think this is kind of the new environment that we're in and it's either going to be mixed use, converted into residential, just the structure of office is going to change?
Sure, I think it's too early to a certain degree. Now I think within office, you have like, you say Class A office is still working in a lot of cases. So it's not all office is bad. I think some office was challenged pre-pandemic. A lot of the suburban office, a lot of this B, C class office is going to continue to be challenged. And so I think, it's going to be very tough to invest in some of those assets until they're fully revalued, and that's the challenge right now. So,
but and to your point, this was in place even before COVID. I mean, look what happened after 9/11. Everyone left the older offices downtown, moved midtown because the technology was there. They were a little bit more employee friendly, if you will. I mean, that
Sure.
trend was in place even before COVID.
Right, exactly. And that's a trend that was, exacerbated because of COVID to a certain degree. But I do think that, office, I think there's still an investment to be had in office. I think unfortunately, there's no trade there today. So at some point, office is going to become very interesting to invest in on the equity side. It's going to probably be more interesting on the debt side in the near term, just because there is just a lack of debt capital. Because obviously, debt capital is, as we've discussed, is really softened across all commercial real estate assets. It's much worse within office right now. There's really very few lenders, if any, willing to lend to an office building.
All right, Greg, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.